In this video, I want to talk through what interest rate captures fundamentally. And some of these things you're probably already aware of, but let's flesh this out a little bit more so we begin not to think of that letter R as some nebulous arbitrary number, but we begin to think about it as something much more fundamental. I'm going to give you a few different interpretations or ways to think about that letter R, but I really want you to understand the first one because that is going to be the most important, the key one. So let's go through them. And the way I'm going to present this first way of thinking about the interest rate, the discount rate R, as with a very simple example. So let's talk through it. The example says you have $100 to invest, you're going to invest it for 1 year, and you have two investment options. You can either put it in a safe Government of Canada investment, we'll call it a bond. You can think about it as a guaranteed account that you have basically with the Government of Canada, or like a big Canadian safe investment. So you're going to put $100 in that if you choose option 1, or you can take that $100 and invest it in a young startup company with an unproven product. Okay, so something super safe, something super risky, options 1 and 2. And so the question for you is, which investment should give you a higher payment in a year to make you willing to part with your $100 today? In other words, which investment should make you richer in a year? Which investment should promise you more? Well, if you are a rational investor, if you're a rational individual, you would recognize that the safe investment, the first investment, is safe, right? It doesn't need to offer you too much in order for you to be comfortable to give the $100 to the Government of Canada. Maybe it only needs to promise you a $3 payment on top of your $100. But those $3 would be woefully insufficient to make you willing to part with your $100 if you were given that $100 to the startup company with this unproven product. It's risky. What if the company goes bust? You lose your $100. Government of Canada is almost certainly not going to go bust in the next year. And so you're comfortable with the lower rate of growth of your money, but a startup company, it better promise you something good, otherwise you're gonna hold on to your $100. And so let's just pick a couple different numbers. So the riskier startup has to promise you a higher future value, otherwise you're never gonna invest in it. The Government of Canada does not need to promise you as high of a future value. So what does that mean? It means that the rate of growth of your money if you invest in option 1 is going to be smaller than the rate of growth of your money if you invest in option 2. Or if you want to tie it back to our equations, we would be using two different discount rates, two different interest rates to connect the value from the present to the value from the future. And for the Government of Canada, the discount rate is going to be smaller. For the startup, it's going to be bigger. Not because of some magic, but because we're rational individuals. And we're all going to say, if I invest in something with this risk, I better get some high return. Otherwise, I'm not going to invest. And the equilibrium forces in the world are going to congregate, are going to aggregate all of these opinions of individuals just like you. And the interest rates in the world are going to reflect that. So look at the interest rate in your bank account. It's trivially small. The discount rate is very small. It's safe. But if you look at what historically the stock market has paid, it would be something like 10% per year. Why? Because it's riskier. And so the interest rates, the discount rates, are going to be commensurate with the risk that an asset has. And this is really, really important. Interest rates are not just some nebulous numbers. They are intimately connected to the riskiness of the asset. Different assets are going to have different discount rates because they have different risk. So R is a measure of risk. Higher R, higher risk. Lower R, lower risk. That is the most important interpretation of the discount rate I want you to have in the back of your mind right now. But I'm going to give you a couple more. The second one is going to be somewhat similar in spirit to what we just discussed, but it's one that people nonetheless often talk about as a distinct interpretation. And this interpretation is the rate of growth or expected return on the money that we invest. And so with the example that we just did, we realized that a safe Government of Canada investment should give us a 3% rate of growth, and a riskier startup should give us a 25% rate of growth. So different rates of growth of capital. People would say different expected returns. Sometimes people would say different required returns. And the logic of using those words is what we already discussed. If I invest in something risky, I expect a higher rate of return. If I invest in something safe, I invest in something that is not gonna keep me up at night. I expect a smaller rate of return. So it's a very analogous way of thinking. Risk and return, we're gonna talk in class that they are highly interrelated. But for now, you can think about it, you can think about the discount rate as an expected return, or the return that's fair given the characteristics of this asset. So first interpretation, risk. Second interpretation, expected return. More risk, more return. More expected return, obviously higher discount rate. I'm gonna give you another way to think about this. And this is a little bit sort of stretching the intuition, but many of you are international students and you're very familiar with converting currencies, and maybe this is going to be helpful to you. So when you convert currencies, let's say dollars to euros, what are you doing? It's still cash, right? But you're just converting it from one denomination to another denomination, one currency to another currency. And maybe the exchange rate is 1.10. So 1 euro buys you $1.10. So what you're doing is you're converting one currency into another at a particular point in time. What do we do when we move money into the future or into the present? We're converting money for money, but not at the same point in time, across time. So you can think about the interest rate, the discount rate, as the exchange rate. So we're exchanging money today for money in the future at some exchange rate. And if the exchange rate is 10%, then $1 today is equivalent to $1.10 in a year. So think about it the same way you think about currency exchanges. Rather than exchanging one currency for another currency today, you're exchanging the same currency for the same currency at two different points in time. And the discount rate captures that exchange rate over time. Different assets are going to have different exchange rates over time, just as different currencies do. And those exchange rates are going to reflect something fundamental about the asset, about the currency. And that fundamental force is going to be ultimately risk. But if it helps you to think about the discount rate through this lens of an exchange rate, this is great. But I want you really, guys, to understand the risk interpretation. This is key: higher risk, higher discount rate.